So many of you will realize is that I am the only thing between you and lunch. So I'm going to be in super turbo mode as I go through that. I'm going to be throwing a lot of data and stats at you. Most of it is coming from this particular financial well-being report. There is a copy on this available at our stand. So please come and pick one up. So what I'm going to talk about today, A Tale of Two Worlds, understanding personas. Using data to bridge the gap. I'm going to talk about a particular persona that we developed called the financial fitness persona, and reframing the HR financial well-being strategy in the language of the board. So let's kick off with the two worlds. So understanding different personas. Personas are useful when they give fresh insights, inform and help formulate strategy, allow actions and results to be easily measurable, and the question is this: are generational digital personas useful? And is there a more meaningful lens? And that's what I'm going to talk about today. We all know about the generation gap. Each generation imagines itself to be brighter and wiser than the generation before. I know that that's what I thought, and I'm still thinking it. Sometimes we talk about the boomers and millennials. So a boomer born between 1946 and 64 might say something like this: "Young man, why are there holes in your jeans? Did you rip those yourself?" Now, a millennial may retort, "Why are those holes in the ozone? You rip them yourself." And of course, Gen X, that's who I am. I was born in 1965, might be somewhere in the middle. So it's all very funny there, very different perspectives. But we really need to understand, and Leonardo da Vinci once said, is that the greatest pleasure is actually the joy of understanding. And so to understand people is that, first of all, what to figure out is that what is it that's influencing people. So what I've done here is that I figured out what is it that people are doing in terms of use of social media, and looking at 25 to 34-year-olds and also 45 to 50-year-olds. And so first thing is Facebook. I mean, it's not that much of a difference. Obviously, they're higher there. YouTube, not much there. WhatsApp. Now we start seeing the differences here. And some of the newer things, especially with Snapchat and Reddit and Tinder, the big differences. So, and also, a lot of things is that they're actually using a lot of different social media here. I told you it's going to be fast. So now, what other environment there? Now, when I was 30, it was 1995. And the average salary at that point was 19,270, and the average house price was 51,000. And in the UK, in London, so that was 2.7 times. In London, that figure was 4.3 to 5 times. But when we look at it today, is that we know everything's got more expensive, but it is a staggering amount, 7.9 times more expensive on average. In London, that figure is not 7.9 times, it's 12 to 14 times, depending on where you are in London. It is just absolutely impossible. So, the people say is that, oh, when I was your age, is that, I did this, I did that, is that I cannot imagine. I am glad that I was born then and not here. Yeah? It's really quite staggering. Also, is that, there was a big study done by Deloitte in kind of asking what is it that you as a millennial are expecting from your employer, and to what extent is your employer actually doing those things. So there's a number of dimensions is that generate jobs. So the first one is what is their expectation, the red column, and the blue column is what they feel their employer is doing. So a bit of a gap there. Now you'll see here, there is a bit of a pattern. Apart from innovate, you can see here, there is a big disparity between the red columns and the blue columns. Right across the board, here and here. That is really, really quite a staggering thing. Is that I know that when I was a lot younger, that was not the case. But you see a massive mismatch here between what millennials are wanting and what it is that what they feel the employers are actually giving. The other thing that we asked in this big survey that we did, 10,000 employees across the UK in the summer, is about worries. Is that we asked about, are you worried about money, relationships, career, and health? And you'll see that everybody there's a characteristic diamond shape here, is that everybody is more worried about money than anything else. But the surprising thing is, the red is 25 to 34-year-olds, and the green and the blue are the older age groups. And you'll see is that the young people are worried about everything much, much more than the older group, by a big, big amount, right across the board. But everybody is worried about money more than anything else. You see that characteristic diamond shape. So, what can we say? So, let's try and understand this, is that what's actually causing this. I'm going to talk a little bit more now about using data and looking at the financial fitness persona. So, looking at millennials and boomers as personas. Does that really help? But clearly there are differences between the two. Millennials are much more worried, but I'm not sure the extent to which, when we're looking at it in this particular lens, how it helps with HR strategy and policy. And it all depends on what question you're trying to answer. So the next part of the presentation is really looking at, does this really help in terms of answering what should your financial well-being strategy be, and how do you communicate that to your workforce? So how difficult is it out there? Now, this is a quiz time for you, okay? And you don't have time to phone a friend, but here you go. It is multiple choice. Is that I'm going to ask a series of 4 questions. So the first one, number of people in the UK with less than £100 in savings, okay? Next one, the average amount of unsecured debt unsecured debt per household, average, okay, the average figure. The representative rate for borrowing £4,000 unsecured loan if you have great credit. And the same question if you have poor credit, okay? I'm going to reveal the answers now. And there is a prize for anybody who got all 4 right? So the first answer is, it's D. It's 17 million people. 17 million people actually have less than £100 in savings. D again, 7,600. Staggering amount. That is the average figure, by the way, average. And that is from ONS data. That's 18.9%. And the last one is actually, it's a bit of a trick question. You can't actually get any credit. You have to resort to payday loans or other things, or borrow from family and friends. It's actually very, very difficult out there. And we basically when we did the study, we basically did of 10,000 people. We found out that actually 40% of the UK population that are working have financial worries. They are 8.8 times more likely to have sleepless nights. 8.8 times more likely to have sleepless nights. As a result of that, obviously, they are distracted at work, thinking about financial worry. They haven't had enough sleep. The most staggering stat is that they are 6 times more likely to affect the quality of their work. 7.6 times more likely not to be able to finish their tasks on time. They're not being able to get their work done on time, so what that results is that a 5.7 times increase in troubled relationships with their employees, with their co-workers, and they're 2.2 times more likely to be looking for a job. So all of that actually has a massive impact in terms of lost days, and it's anywhere between 13 and 17% of the total salary cost. And the other thing that, when we start looking at the data, and as the data is really, really important, is that we came up with this other staggering stat and insight, is that the average is 40%, but the highest number of worries is with this particular income group here, which is not surprising, the low earners. As you start earning more money, it starts going down. But you'll see here, there is another group that has the highest level of financial worries. It's the group that are earning over 100,000. 49% of them have financial worries. We also asked 2 other questions. One was, to what extent do you agree or disagree with this following statement? I am depressed and find it difficult to carry on with life. We asked that question to 10,000 people, the extent to which they agreed or disagreed. And the result is quite staggering. Those that have financial worries are 4.9 times more likely to say yes to that question, and 3.8 times more likely to say yes to being anxious and being prone to stress attacks. Not 20% extra, not 30% extra, 4.9%. So 4.9 times. Those that have no financial worries is about 9% of those will agree to that statement. And those that have financial worries, it's almost 50% say agree with that statement. Absolutely staggering when you actually get into the data in terms of the level of stress that people are under. So how do we make sense of this? It's not about income, and we also looked at gender differences as well. It's not about genders either, and it's actually, there's not a lot of difference in terms of ages either. So what we came up with was a different way, a different lens of looking at this. We asked a set of 10 behavioral questions. As a result of those 10 behavioral questions, like do you run out of money before payday, etc., we came up with something called a financial fitness persona. And so you're one of four. Number one is that you're running out of money before paycheck arrives. Number two is that you're just about managing, but you feel guilty when you spend for those little luxuries. You can't, when you take the kids out and to the cinema, you feel guilty about getting the popcorn because you really can't afford the popcorn, but you're doing it. But you're still feeling guilty. Number three, everything is kind of just about hanging there together. You're making ends meet. But if something unexpected happens, like you need a new set of tires on the car or your boiler breaks down, you are in trouble. You're going to have to take out an emergency loan. Four are those people who have a plan in place working towards financial freedom, and five have achieved financial freedom. This is a distribution of those personas across the UK. And you don't have so many here, 5% here, 6% here. But look at this. Those that have a score 1, 82% of those have financial worries. Now remember what that means in terms of mental health. And those that score 2, 69%. And of course, these guys here, still some people are worried about other things. Now, when you look at the data in that way, it's quite a bit of a surprise. But there's another way of looking at this. And this is the real tale of two worlds that I want to talk to you about today. Is that when we plot this as a bar chart, we see this particular distribution. The red, the younger generation, and the blue, the older generation. One thing that you will notice is that this characteristic double peak chart here. This is a bimodal distribution. The best example of bimodal distribution is Amazon book prices. There is a peak at $25 and another peak at $10. The $25 peak is for hardback books, and the $10 peak is for softback paperback books. They are both in the population of books, but a hardback can never be a paperback, and a paperback can never be a hardback. And so we have the same thing here, is that this is the population of people. But you're seeing two distinct groups here. You have the population of 4s, and you have the population of 2s. The difference between 2s and 4s, our hypothesis is the following, is that 4s are those that are aware of, understood, and embrace the concept of capital accumulation, asset creation, and deferred gratification. They are the natural savers. I am a natural 4. I remember when I said, oh, Mum, I'd like that when I was a little bit younger, is it said, no, you have to save for it. Dad, I like this. You'd have to save for it. And I started becoming a 4. I was a natural 4. The 2s do not understand, they have never come across that concept. They do not understand that concept. They do not embrace that concept. So their natural behavior results in their score of 2. Okay? And they're two distinct populations. You will also notice here is that it's not a matter of age. Although there are slight age differences, you still see the characteristic to the bimodal distribution. This was an incredible insight that is actually a tale of two worlds, the 2s and the 4s. So what does that mean in terms of thinking about your well-being strategy and thinking about what you need to do in terms of talking to your board? So the language of the board is obviously they're looking for objective measures, KPIs, they're looking for benchmarking, targets, actions linked to measurable results, cost-profit impact, and also ROIs. So a financial well-being, a potential way of doing this actually is to use this fitness score persona, because every individual has a score, and actually the average of your employees can be a fitness score for you as an employer. And so that is an objective KPI. You can measure it on a regular basis. It's those 10 questions that go out there, come back. You can also benchmark that versus your other peer group. You can set all kinds of ways in which to measure the impact of your financial well-being strategy and see what impact that has on improving the fitness score and what the cost of that has been. And this is the kind of the model. It's in the guide. I won't go through it in a bit more detail. And so when you're thinking about this, is that way we think about what your offer might be, or the way that one way of looking at this is the following way, is that you can look at things that will have a short, in terms of impact, things that will take years to achieve, and things that will take days to achieve, and the impact of each of those particular interventions, so low impact, high impact. And so financial education is very, very important. It has a relatively low impact. It does take a long time to long time to have an effect, but it's a very important part. We've got save products are there, financial fitness score is there, and load advanced products. Each one of those has a slightly different aspect and different things to do. And what we're saying is that actually you need to have something, an offering across all of those areas, because different things make for different people. And another way of doing it is to actually thinking about the persona. And if you look at the financial fitness score persona, then you basically, if you think about education needs and about product needs, is that these are the things that the ones need, the twos need something different, the threes need something different here, the fours here, and the fives there. Each one has a very different requirement. If you do not know, or if you don't segment or have the personas correctly identified within your group, or you don't know what the mix is in your organization, you are going to end up basically providing them things that they don't really need. The needs of fours are very different from the needs of ones. And so, the other way you can use personas is to communicate to taboo projects and taboo subjects. So obviously there is a profile, a case study. This is Richard here. There's a little bit of a backstory in terms of what he's doing. Again, the reason for doing this is to depersonalize the effect. We know that a lot of ones and twos, they don't like talking about their financial position because they feel embarrassed. They feel as if they are unintelligent. And when they talk to a four, they feel very stupid. So you've got to find a way to basically depersonalize it. So personas are one way of doing it. They can kind of identify with these individuals rather than actually taking anything personally themselves. So the tale of two worlds, personas are invaluable in understanding the issue and formulating communicating strategy. It's not about generations, it's not about gender, it's not about education levels, and it's not about pay levels either. Using twos and fours as a different kind of lens could potentially give you fresh insight. And financial well-being strategy needs to address the differing needs of both twos and fours. And any strategy needs to have KPIs that are objective, measurable, and things that can actually relate to outcomes and things that you're doing. Thank you very much.